Yeah, there are basically two things. One is that inflation is coming down. We've made a lot of progress on the inflation front already. Headline inflation has gone from above 10 to below 3%, and wage growth has remained fairly firm. And so on an inflation-adjusted basis, we think households will face a better income picture as we go into 2024. So that's the first factor. And then the second, as you mentioned, is that falling inflation also means that monetary policy can be more friendly next year than it has been over the last year. And it's pretty clear, we think, that the ECB is done here hiking, and the discussion really is around when the ECB will turn to cuts. Now, in our base case, where growth holds up next year and inflation remains above 2%, we don't think they're going to be in a particular rush to cut. But they will cut, we think, in the third quarter. And importantly, of course, they have the option to cut earlier, which is quite different from what we saw this year. And so when you put that together, we think that's a somewhat more constructive picture for next year than it was this year.
I want to come on to the ECB in just a moment, but first on the manufacturing side, I mean, we've seen really depressed activity across the Eurozone. It's been pretty disappointing. How do you see that affecting the growth picture? Because a lot of the pressures that we've seen in the manufacturing space have come from outside the Eurozone.
That's right. So we have seen the gas crisis weigh on manufacturing activity. We've seen higher interest rates weigh on activity. We've seen weaker growth abroad, particularly in China, weigh on activity. Now, we think the manufacturing picture is going to get a bit better next year, but not dramatically better. So it's not really the driver, we think, of the growth resilience next year, because you have, on the one hand, stable interest rates and the decline in gas prices that we've seen relative to where we were a year ago. That should be helpful for manufacturing. But the global growth environment, of course, is going to remain, a little bit more mixed. We are quite optimistic on growth in the US, but we're a little bit more cautious on other places, including China and also including the UK.
You talk about the ECB becoming more friendly. That was the word that you used, and looking at a potential cut in Q3 of next year. What happens once they cut rates the first time? What is the path to lowering rates, becoming more accommodative look like?
Yeah, I think it will depend importantly on the growth picture at that point in time. So in our central scenario, where we just said the economy is relatively resilient, we think they will cut fairly gradually. And so what we have is a 25 basis point cut basically every quarter until you get back to something like 2.5%. So that's the central scenario, which is a fairly benign one. Now, of course, in the past, they have cut more quickly, but that has usually coincided with a much weaker economic backdrop, where the economy was sliding into recession, the unemployment rate was rising quickly. So I would say baseline is for a gradual reduction, because inflation, keep in mind, is still above 2% in our forecast for next year. But of course, if the unemployment rate were to move up more quickly, they have the option of cutting more swiftly.